Happy Friday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Friday, March 8th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So we'll start with today's key macro event, which is the soft landing scenario won the week. So the nuance there is that the key economic release for the week, which is the February jobs report, supported the no landing scenario, or sorry, the soft landing scenario. It supported the soft landing scenario. Additionally, the latest consumer credit and household net worth data were supportive as well, in line with the ISM Services PMI report from earlier in the week. Elsewhere, Powell doubled down on his surprisingly dovish testimony before the House Financial Services Committee Wednesday in yesterday's testimony before the Senate Banking Committee. In terms of market implications, what we learned this week is that the Fed chair is in no hurry to cut rates, but is in even less of a hurry to pivot back to higher for longer forward guidance, or worse, discussing additional policy tightening. We see a pivot to a more hawkish policy mix as likely in 2H24 in the second half of the year, if our current combination of econometric forecasts and qualitative research views proves prescient. It is, however, only early March, and that implies there is plenty more money to be made in this raging Montauk bull market in risk assets that we correctly and consistently called for. Transitioning to our 42 macro dashboard here. We start as always with trading range signals from our friends over at Longbow, getting an oversold signal here in the dollar. So your dollar tends to be inversely correlated to risk assets. So a good signal to kind of take down some risk from a tactical standpoint. If you are a high frequency trader, if you're a low frequency trader or medium term asset allocator, generally ignore this part of the program because that's what these trading range signals are focused on. It's focused on people who are in the markets making decisions on a regular basis. Getting an overbought signal here in the Russell 2000 as well. So that's consistent with that dollar oversold signal. And then lastly, transitioning to a question for from a question from a client from here in our 42 macro community chat, which I'm a huge fan of, obviously. And a lot of you guys are huge fans of that as well. So reading the question here, can you please share expectations for today's NFP report? Are there any strategies we can implement to initiate trades before its release, aiming to capitalize on significant movements and volatility in the report's publication is likely to cause? Thank you for your time. So I'm happy to help. So I'm just going to read my response and then elaborate on my response, which is, hi there. I'm happy to help. And the answer to that question is none. No, there are no. I don't have any expectations for any jobs report. To this day, I've never met a single human being, buy side, sell side, retail financial advisor that's really secured their own family's financial future by consistently guessing the non-farm payrolls report on a consistent basis. And the reason for that, by the way, is because the standard deviation, the standard error of the NFP reports is about on headline payrolls is it's over 100,000. So if you build a model, and this is some of the best models in the world, I've seen this from even beyond our own ability to create models. The best models in the world have the standard error in the area code of 100 plus thousand a job. So on a number that can go from, let's call it 100K to 300K, you're talking about a standard error of 100K. That's pretty significant, and no one's going to put any meaningful amount of capital to work for something for a model with a standard error that wide. And generally speaking, if you're a retail investor or a financial advisor who's managing the money of retail investors, you have absolutely no business trying to predict Mac in position for economic releases. Leave that stuff to the pros. You don't have good enough models. You don't have good enough tools. And more importantly, it's just not the way to get rich. The way to get rich is to be long assets in bull markets and to sell them at or near the peak of bull markets and buy them back at or near the bottom of bear markets. Trying to gameplay, I'm going to forecast every single economic release correctly because I think I'm the best investor in the world since sliced bread ever came out. That's gobbledygook. It's no one does that. I spend most of my career flying around the world, meeting and learning from and educating some of the world's top investors about macroeconomic risk and market and how to create models and investment portfolio constructions to take advantage of those risks. And the reality is, we never have conversations about, okay, what's your data point forecast for this particular indicator, so I can put this trade on. No one does that. No one does that on the buy side. So you shouldn't be doing that as retail investors because the reality is there is no value add in those types of strategies. So just if you want to be a good investor, the best thing you can do to be a good investor sorry, not a good investor, a good trader. If you insist on trading and you want to make a litany of investment decisions, we're obviously here to help and support that. We have clients who do all kinds of investment strategies. That's one of the beauties of 42 Macro. But if you want to be a good trader, the best thing you can do to be a good trader is understand what the consensus narrative is and understand and accurately forecast the data points that are going to cause consensus to either build conviction in that narrative or erode conviction in that narrative. That is how you become a good trader, is understanding how the narrative is going to evolve that are really dominating a market forces in terms of creating the market regime. And so that's something that we focus on explicitly every day in our lead off morning note, and obviously every week in our around the horn. And ultimately, where that research is really born out of is monthly in our macro scouting reports. And by the way, we got our March macro scouting report coming out this afternoon. So that's 135 slides of all the stuff that uh, all the stuff that you're not seeing and not hearing, and on the charts that you're not seeing in the Bear Porn podcast world. So if you like that kind of stuff, definitely come check us out. If you don't like that kind of stuff, you probably don't like making and saving money in financial markets. Everyone have a great weekend. Cheers.